Hey guys, good morning and welcome to the Camp Financial Stock Market Update. So let's just start with how it went yesterday. Yesterday was a rough day in the markets. Specifically, I know not just the market as a whole, but I know that my portfolio took a little bit of a beating yesterday. A beating. Some of the companies I'm in, had some news come out, had some rough days. Fitbit, for example. Let's go into that, right? So Fitbit, rumor was out that they were probably the earnings were probably going to be in line, which they were, and that maybe the guidance wouldn't be there again, much like Fitbit has continued to do since they went public. They have not really given the street much fodder or much interest in keeping their stock price up. They've consistently just kind of said, well, and we're not sure about our earnings going forward. And this time they came out, they said a pretty similar story, and they said, but they are keeping their 2016 earnings in line. They expect everything to continue to play out as they originally expected at the beginning of the year. So through the day yesterday, Fitbit dropped 4-5% roughly. I know at one point in time it was definitely down 5%, but I think it ended up just under 4% down for the day. And then the earnings came out after the close yesterday, and since then the stocks rallied all the way back up through where it's been. Gosh, I don't think it's been at this price for 6 months or so now. But Fitbit's looking at opening up right now. I just checked the pre-market, and it's at $14.10 after it ran all the way down almost to $13 even. So that's a nice 10% pop. Obviously most people that are going to get that 10% pop probably also felt the pain, right? Yesterday while it went down. So we're making the money back, but yeah, so it's just something I thought was interesting, and like I said, it's one that I'm invested in, so I keep an eye on it, and that's why I knew what happened with it. So let's take a look at the heat map. So basic materials performed well yesterday. It's pretty much the only green area. There's a little bit of green in the service sector here. You see that's the drug wholesalers, Macys. Let's see who else. Biotechs again had a pretty decent day. Biogen up 9.37% yesterday. Pipeline companies performed well. Kinder Morgan. Aerospace actually performed pretty well with the exception of Boeing. Aerospace and defense products. And that's most of the green. Maybe cable TV. It was okay, had a decent day. And then the oil and gas refiners had a pretty good day as well. So like I said, that's pretty much it. A lot of red, a lot of bright red. Airlines, bright red. Apparel stores smacked pretty good yesterday. Department stores smacked pretty good yesterday. Grocery stores, pretty much anything retail took a pretty significant hammering yesterday. Clothing manufacturers on top of the stores, Ralph Lauren, Van Heusen, Michael Kors all had a rough day. One that I'm in, I know, had a pretty rough day as well, and that's Coach. So yeah, all around, just a pretty rough day in the market yesterday. Let's take a look. So the Dow ended up down 0.5%, the S&P down 0.64%, and you would think with all of that pain that there'd have been the indexes as a whole would be down a lot more, but you know, there's enough counterbalance in there to help move the market along and not let everything get completely crushed. So let's pull up the S&P 500, the worst performers in the S&P yesterday, the bottom 5. Again, all the service sector. That's Kohl's, Delta Airlines, Macys, Nordstrom's, Staples, Royal Caribbean Cruises, United Airlines, AutoNation, the auto dealership, American Airlines. You know, so the bottom 9, all service companies. Also in the, I guess in the 11, so you got to go to 11, but then you pick up Gap at 11th. So service industry, rough day yesterday in the markets. Even on top of, like I said, the service industry, then you've got the consumer goods, which is a lot of the same stuff. I mean, Michael Kors, Fossil, Ralph Lauren. I mean, that's, most of those all have their own stores, even though they're technically considered apparel companies. I mean, they have their own department store, and pretty much anybody with a storefront, for the most part, got hammered yesterday. Let's look at the percentages. So Kohl's down 8%, Delta Airlines 7.8%, Macys 7.25%, Nordstrom's down 6.86%, and Staples down 6.4%. The Macys thing is interesting, you know, because you could have bought into Macys in May after it took its last drop from earnings, and you could have got in right around $30. And you know, you're never going to pick the exact bottom, you're never going to pick the exact top, but through that span, you know, at one point in time Macys was up 25-30%. I mean, they were up $7 to about $37 just about a week ago. You know, and then now with the earnings coming out, they've fallen back off. Macys is one that's very intriguing to me, especially possibly to get in at some of these lower prices. I'm gonna have to probably, I think I need to do some deep research into Macys and figure out what do they look like going forward, because we're talking about a company that at the 32, let me see where it closed at yesterday. At the $32.76, you're talking about a company that pays over a 4.5% dividend. They do scare me a little bit with their debt, but I mean, if they can continue to bring in the cash like they're bringing, sales continue to be strong, you're paying that kind of dividend. It's very intriguing to me as a possible play at this $30 level, and then, you know, letting the dividend compound in there, and you know, hopefully, you know, seeing the company run from there. I mean, huge company, they're going to figure out you know, what they got to do in order to compete in this marketplace. Obviously, with the majority of business now being done online, they'll figure their way out. So now let's look at the top performers. Mallinckrodt, #1 performer, healthcare, drug manufacturer, generic drugs. Biogen, like I said, had a big day. Dun & Bradstreet, a tech company. They do a lot. I'm in the insurance industry, so they do. I know the name. They do a lot with the insurance World, Discovery Communications, and Williams Companies, the oil and gas pipelines. So they were up. Mallinckrodt 14.16%, Biogen 9.3%, Dun & Bradstreet up 7.6%, Discovery Communications up 6.6%, and Williams up 6.35%. So that's where the counterbalance kind of comes, right? The S&P 500. That's why there was not the big drop in the index. I mean, even though a lot of companies struggled, there were obviously a fair amount of companies that also performed very well and helped to keep the index from cratering. So looking at the Dow, you got Pfizer down 2.47%, Apple down 1.48%, Goldman Sachs down 1.34%, Boeing down 1.21%, and the Home Depot down 1.12%. Goldman Sachs is one I think is pretty interesting, right? It ran from 140 almost to 165 from kind of the end of June, and it's started to drop back off. I could kind of see a range here looking at their chart where they look like for the last few months anyways. If we go clear back to the beginning of the year, and it kind of looks like 165 is kind of the high and 140 is kind of the low, and they've just kind of range traded it through that spectrum. The interesting thing, and if people say technical investing doesn't work, or you watch the chart and understand it, they probably need to do some more research, because technicals do a significant part. I mean, if you can read the fundamentals and the technicals, you're going to have a pretty successful career in investing. But the thing is, so if you understand the business of Goldman Sachs and their fundamentals, and then you look at their charts, so if you know something about the company, let's not even use Goldman Sachs. So if you know something about a company that is a competitive advantage, just some sort of knowledge about their fundamentals, and you see a company, so maybe you know that they've got good fundamentals, good competitive advantage. You see the company pop and hit the 200-day moving average and pull back, and hit the 200-day moving average and pull back. But then you see it push through the 200-day moving average. Guess what? That's probably a buy sign, because if it pushes through the 200-day moving average, you've now got a lot of technical support from the hedge funds, from these high-frequency traders that are trying to keep the stock above the 200-day moving average. And on the opposite side, like Goldman Sachs here, it's hit the 200-day moving average and it's pulled back. Well, if it's hit the 200-day moving average and now pulled back, it's going to continue probably to push back down until it's going to bump back up against it, and then you got to wait and see if it breaks through. It may be a time to buy. So just, I guess, some additional things to look at, things to consider when you're looking at long-term companies to buy. If you can see a technical trend that's telling you that it's time for the stock to pop up, that's a good secondary thing to know about investing, is know the fundamentals and know how technicals work, because technical trading in this day and age is very, very important. So that's it for today, guys. If you have any specific stock questions or ideas that you want to throw at me, send me an email, chrism@campfinancial.net. You can also find me on Twitter @cmelik, and you can find me on Facebook, Chris Melik, and I would be more than happy to analyze a stock. My next, over this weekend, I'm going to go over one of the write-ups I recently did on a auto manufacturer, not one of the big auto manufacturers, but like a parts manufacturer, just to kind of give you an idea of some of the research that I did on it, so you can see how I analyze different information on stocks. So that's it for today, guys. Take care, and we'll see you tomorrow.